Hey everyone, Douglas here, Kenna Market Analysis, and welcome to the weekly macro update. It is Sunday, April 19th, 2020, 10:48 p.m. Eastern Standard Time as I hit record and we get things rolling on this week's look at the data. And we're going to kick things off with our YouTube preview look, continuing a discussion that we started 2 weeks ago with regards to the Federal Reserve's response to the financial fallout from the COVID-19 pandemic. And if you haven't yet watched it, go take a look at that video. Again, it was on QE, in particular, that last video. And one of the things that we kind of touched on was essentially that QE isn't really doing what most people think that it's doing. In fact, it kind of has almost a counter effect that I think what is generally thought of. It's definitely not inflationary. There's no money printing in QE. It's really just an asset swap. And I think it's best understood that way. And when you understand it that way, you can kind of see how it contributes or what it does to the larger economy and the flows that you kind of want to pay attention to ultimately when you're trying to make kind of investment or trading decisions. So watch that. That'll give you kind of the premise for where we're going to move on to tonight, which is a look at the kind of the other side of the coin, if you will, to what the Federal Reserve has in terms of tools in its tool bag for combating economic crises or whatnot. And the other side of the coin, or the other major tool that they have, is setting interest rates higher or lower, adjusting interest rates. So that is what we're going to talk about tonight. And kind of general theory, if you will, is that lower interest rates spurs on the desire to borrow, and that can increase economic growth from there. So every time there is a slowdown, the Federal Reserve will lower interest rates, and the thought process is with lower interest rates, that's going to make people, have a desire to go borrow, and therefore that will it'll spur economic growth. Kind of like with QE, I think maybe you can get where I'm going with this already, but I'm not exactly sold on that. And that's what we're going to look at tonight. I really don't think there's too much evidence. In fact, I think there's evidence to the contrary that shows that lowering interest rates spurs, the desire to borrow, spurs economic growth, spurs inflation. In fact, again, kind of to the contrary of that. And we're going to look at that data tonight, and then try and maybe tie it together with some conclusions that we can bring to just kind of our overall trading worldview, if you will, to try and just make better decisions as traders. So again, the general theory: lower interest rates should spur economic growth. And I just don't think the data, really shows that out. And I think when you actually look at the data, a different picture emerges in terms of what's actually happening with lowering interest rates. So what I have pulled up to kind of get this, get this story going, if you will, is a chart of the 10-year Treasury yield. So that's going to be in red. And then total credit to household and nonprofit institutions serving as households adjusted for breaks of the U.S. Essentially, private debt to GDP, household private debt to GDP. Okay, so we are looking at yields versus against, essentially private, so household, individuals, debt to GDP. And what you're going to notice here is a complete lack of correlation, right? And notice how as interest rates went up into the 70s, something like 65 into the early 70s, we saw private debt to GDP essentially down to sideways, continue to kind of go on up in terms of interest rates into that point until finally we get to interest rates really start taking off, and right along the way you have private debt to GDP or household private debt to GDP take off at least until the early 1980s. We go through that recessionary period in the early 1980s. So you're kind of back to a brief correlation between interest rates and private debt. But again, I think as you'll see, there might not be. It might be more coincidental than it is actually a correlation there. And then you finally get to the point that I think solidified at least the mainstream view, which is heading out of the kind of mid into late 80s, all the way until 2000 and really 2000 and then 2008. It's kind of a two-part event, but you have interest rates continuing to push down all the way until 2008, with private debt to GDP pushing up the entire time. So you get kind of the bubble economy that emerges out of there. Obviously, how you get the housing market bubble and all that sort of stuff, and that's where I think that, again, that theory came about, and that theory applied to the economy across the board. And then since then, we've seen private debt to GDP, household private debt to GDP, again, flatline or go down, and now we've kind of flatlined over the last half decade or so, with interest rates continuing to push lower during that same amount of time. So the point is, sometimes you see correlation, sometimes you don't, and I really think ultimately it's more coincidental when you do see correlation. You've also seen other countries in completely different circumstances with yield curves, at a vast difference. You look at Japan, and back in the 80s and 90s, they were having a housing boom at like what 2.5% on the 10-year yield, I believe, and at the same time, like Australia was at 17%, and they were also having a housing boom start at that time period as well. So you've seen many different circumstances worldwide just never exactly show the sort of correlation you'd want to think that there's some sort of behavioral response that's going to occur by lowering interest rates. One thing that just to digress a bit, and I might touch on this again in another second, is you might see some indication that lowering interest rates will at least keep people solvent for longer. And I'm thinking more on the corporate side, right? So obviously on the corporate side, in order to kind of continue to stay alive, you're going to continue to binge on cheap debt, and that might allow corporations to continue to tread water for longer than they would have. And in part, that's why we see some things inflate during lower interest rates, right? That's why we did get a housing boom during the really 2000s into 2008, when it really took off, right? It allowed more people to stay solvent for longer. There might be some validity to that, but you certainly don't necessarily need an interest rate, a lower interest rate to necessarily achieve that per se. And again, I think I can have some more data that's going to kind of prove that point. So the big thing that I wanted to get across here is, I don't think you can, make any conclusive, draw any conclusive, data out of any conclusive outcome that there's some sort of correlation between some sort of behavioral response to lower interest rates and this desire to go ahead and spend more, and therefore inflate the economy. So there's that takeaway. The next thing, just to kind of think about this even more, is why would necessarily lower interest rates spur on higher prices, right? What is it that would cause that? Because in my mind, and I'll try and prove this in just a second. If interest rates, let's just say, tomorrow the Fed were to raise interest rates to 10%, right? If that happens, then that means the cost that I have going into the future, right? If I have any projects underway, if I'm, developing anything, if whatever I'm doing, if interest rates are at 10%, so they go from essentially 0 to 10% tomorrow, I know then that my cost of doing business is already 10% higher. That's going to be baked into everything I'm doing, and that is going to be the behavioral signal, if you will. That's going to be the market signal for me to actually raise prices on anything I'm doing, right? And so this is a point Warren Mosler has made in the past, and I think it's a point that's spot on, is that actually higher interest rates are going to lead to a higher rate of inflation, or at least not even necessarily a higher rate of inflation per se, although it can, but it's going to lead to higher prices into the future, because those prices have to be baked in to the business you're doing today. And you're going to, you're going to see that in order for me to finish, phase 2 of whatever project I'm on, and I know borrowing costs are now 10% higher, that has to be, that has to be put on the books for today, so I can plan for tomorrow. And to kind of show this in a little bit more, I guess, concrete ways, what I'm going to do is actually pull up a chart of the yen by gold, or the gold valued in yen here. So we are looking at the front month divided by the following month of the spread here of yen and gold, and what you're going to notice is a straight line right across. There are very small, obviously, fluctuations, but over time, the spread between the front month and the preceding month of gold in yen is completely flat. And why is this? Because the price of anything into the future for anything denominated in yen has been zero for almost 3 decades now, right? They've been at the zero bound for a very, very long time. I guess really only about 10 years right at zero, but prior to that, Japan has had near zero interest rates for going on 3 decades, and so you've seen this flat curve across the board. Now, when I switch over to the U.S., or to now dollar, I should say, dollar and gold, you're going to notice times where from 2016 up until 2019, we start to see, again, gold front month divided by prior month, or the following month, you're going to see this spread begin to emerge between the two contract prices. And this, in my mind, shows that future cost is being priced in, right? The next month out is being priced in. Now, this doesn't necessarily mean that the price of gold or the price of anything is going to go up or down. That needs to be very clear. What this means is that the assumed future price of whatever is going to be how many percent higher interest rates are set at into that next time period that they're set into, right? And so we see this play out in spreads across the board. So again, when it comes to actual price, say, of gold, there's a lot more to consider: supply and demand dynamics, speculation, that sort of thing, other global macro factors are going to price into gold. That's not the point I'm trying to make about the actual price. What I'm trying to say is that spread is going to push higher up prices into the future because interest rates get pushed higher, and therefore those have to be accounted for down the line in pricing. And obviously, since then, we've plummeted right back down to the to the zero line, if you will, and in terms of the curve, and we'll stay here as long as we have 0% interest rates, just like Japan. And if we ever start raising interest rates again, and we go through a cycle of rising, then we would expect again this to emerge higher. So, putting all that all together, I'm going to switch back to this chart real quick, because I kind of summarize all this. Putting this all together, I don't think that there's any reason to believe that lowering interest rates is going to spur economic growth. I do think there's good reason to believe, and there's kind of good logical arguments that follow, that it spurs financial growth. It spurs financial markets to push higher. That's definitely one of the things I look for in kind of my big equation, if you will, in terms of how we view the whole process of understanding markets. Is lower interest rates usually spurs financial assets to push higher, because you're not getting the normal yield that you would be on bonds, and therefore equities look kind of more safe, if you will, or more attractive because of that than they otherwise would have had you put on, had interest rates been at 10% or whatever. So there is that impact. But this idea that low interest rates are inflationary in any real sense to the economy, or in any real way are they quote unquote good for the economy, that they grow the economy, is just not the case. It's if anything, it's the exact opposite. Because if you do jack interest rates up to 10% or 20%, you'd obviously get inflation. You'd get people wanting to get rid of their dollars more quickly, or at least get them into some sort of interest generating asset. And so you'd see velocity of money start to pick up, and that sort of thing start to roll over. So you'd expect more inflation at that point. So I think there's a lot of reasons to believe that kind of just macro theory, or it's not even macro theory, I guess this would be more just economic theory, classic kind of neo-Keynesian economic theory, or really classic Keynesian economic theory, just doesn't have this understanding correct. And I think some more thought definitely needs to be put into this from a academic standpoint, but from a finance standpoint, I certainly don't think that our expectation should be that we're going to see some big, bubble across the board in countries that have put things to the zero bound. And a great example of this would be Europe as well, right? Because they've kind of gotten this for the last decade as well, and they haven't seen any growth out of this either. So, the factors that cause growth, the factors that cause an economy to expand and that sort of thing, I think are far set outside what the tools that are available to the Federal Reserve can actually do. And I think that would be kind of my brief summary from this update and the update 2 weeks ago, in terms of why I really think that the tools the Federal Reserve has available to it are really just not all that impactful in terms of getting the economy in the direction that policymakers would like, and if anything, kind of can be a countermeasure towards what it is they're actually trying to pull off. So, yeah, those are my thoughts on kind of the interest rates and kind of how to think of them and whether or not they're going to be effective. And hopefully a unique perspective on this whole idea as a whole. So for this week, I'm going to wrap things up here for the preview look, and then we'll continue on taking a little bit deeper dive into some of the other things the Fed have done in weeks to come, and then maybe if you have any thoughts that you'd like me to maybe try and look at next time or into the future, let me know in the comment section below on the YouTube page, and we'll see if that's something I can incorporate into the future. All right, that is going to wrap things up for this preview look at the macro update for this week. If you like what I'm doing here and you haven't yet subscribed, make sure you hit that subscribe button. And if you found this video specifically helpful, give it a thumbs up as well. And if you really like what I'm doing here and you want to see the entire update that I have to offer, as well as everything else that I publish on my research and analysis, make sure you check out my or head on over and check out my Patreon page over at patreon.com/CannonMA. You get obviously tonight's complete update again, as well as everything else. So head on over there. Anyway, I'm going to wrap things up for this update tonight. So good trading for the rest of the week, everyone, and we'll see you next time. Bye-bye.